Welcome to The Explainer. Today, we're diving into something that's totally shaking up the startup world, the angel syndicate. Think of it as a super smart fix for some of the biggest, most annoying problems in early-stage investing for everyone involved, founders and investors.
For the longest time, the whole system just felt broken, right? You've got these brilliant founders grinding it out, spending ages pitching to investor after investor. And then on the flip side, you've got people who would love to invest but are totally locked out. The buy-in is too high, or they just can't get access to the good deals. So how do you solve that?
Okay, so before we get to the solution, let's really dig into the problem. It's kind of like two sides of the same coin, these two big, connected challenges.
So picture this. If you're a founder, it's just this relentless marathon of pitching. You're trying to build a company, but you're spending all your time asking for money. And if you do manage to raise the funds, you're stuck with this super complicated cap table, like a list of 100 different investors to manage. And for the investors, well, a lot of them are just stuck on the sidelines. It's tough to find deals that have actually been checked out. And who has 50 grand just lying around to put into one super risky bet? Most people don't.
And that is the exact problem that angel syndicates are here to fix. So what's the playbook? How does this whole thing actually work? Let's get into it. Okay, at its heart, a syndicate is just about teamwork. It's simple, really. Instead of a bunch of investors all trying to do their own thing, they pool their money together to back one startup. And the secret ingredient? They follow a lead investor. This is usually some expert, someone who knows the industry inside and out, and they do all the heavy lifting for the group.
The whole setup really boils down to three key roles. First up, you have the lead investor. This is your quarterback, right? They're the ones finding the deals, kicking the tires, doing all that tough due diligence. Then you have the syndicate members. These are all the other investors who get to see the lead's homework and decide, hey, am I in on this? And of course, you've got the founder who gets this huge win. They pitch to one organized group instead of, 100 different people. And the process is actually pretty straightforward. So the lead finds what they think is a great deal, and they just dig in. They do a super thorough review. Then they write up this detailed memo, basically, here's why I think this is a winner, and share it with the members. If enough people say yes, everyone chips in their money, and bam, the deal is closed. It's a really clean step-by-step process.
Now, here's the little bit of legal magic that makes this whole thing possible. It's called an SPV, or a special purpose vehicle. The easiest way to think about it is like a little basket, an LLC usually, that holds all the individual investments. So for the founder, instead of having 50 different investors cluttering up their books, they just have just one line item. It is so clean, so simple. It's honestly brilliant.
Okay, so it's pretty clear this model solves a ton of problems. But, nothing's perfect. Like any strategy, there are trade-offs. So let's get real and look at the pros and the cons for everybody.
If you're an investor, the appeal here is massive. All of a sudden, you're seeing these amazing pre-vetted deals that you'd never find by yourself. The lead investor does all that, let's be honest, boring and grueling due diligence work for you. And the best part? You can spread your bets. You can put smaller amounts of money into lots of different companies instead of putting all your eggs in one basket. Get this, $1,000. That's the minimum buy-in for some of these syndicates. Think about that. That single change has completely democratized angel investing. It has thrown the doors wide open to a whole new group of people who, before this, were totally on the outside looking in.
And for founders, the wins are just as huge. Fundraising is way faster, way more streamlined. Remember that SPV? It keeps their cap table squeaky clean, which is so important when they go to raise more money later. Plus, getting the stamp of approval from a respected lead investor, that's instant credibility. And it often comes with a ton of great advice and mentorship.
2 to 4 weeks. Let that sink in. In the traditional VC world, raising money can take 6 months, maybe more. For a startup that needs to move at lightning speed, closing a round in under a month is, it's an absolute game changer.
So when you step back and look at the whole picture, it's this amazing win-win. Investors get access to great deals and can diversify their portfolio without having to do all the legwork themselves. Founders get the money they need, fast, plus a whole network of supporters. It works. It nails the core problems for both sides. But, okay, let's not get carried away. It's not a perfect system. There are definitely risks. For investors, the big one is that your money is tied up. It's illiquid. You can't just pull it out tomorrow. And you don't really have a say in how the company is run. For founders, even with a lead, you're still dealing with a big group of people. And that can mean a lot of different opinions and a ton of communication to keep everyone in the loop.
7 to 10 years.
If you're thinking about investing, you really need to let that number sink in. That's how long your cash could be locked away in one of these startups. There's no sell button. This isn't the stock market. It takes some serious patience and a really long-term view.
And all that expertise from the lead investor? Well, it doesn't come for free. The price tag is usually 20%. That's the standard carried interest, or carry. It's basically the lead's cut of the profits if the investment pays off. It's their reward for doing all that work up front. But if you're a member, you've got to remember that that 20% comes right off the top of your potential profit.
All right, so let's zoom out. What does the rise of the syndicate model really tell us about where investing is going? What's the bigger picture here?
You know, there's a great quote from Matthew Wilson at Allied Venture Partners that I think just nails it. He says, "Angel syndicates are reshaping early-stage funding by aligning the needs of startups with the resources of investors." And that's it, right there. That's the core idea. The whole thing works because it's built on cooperation. It takes this clunky, inefficient process and smooths it out by pooling everything, not just the cash, but the knowledge and the trust, too.
And that really leaves us with one last big question to chew on. Syndicates have taken this incredibly high-risk, high-reward world and made it way more accessible, way more efficient, all through collaboration. So it kind of makes you wonder, right? What other huge, complex industries out there are just waiting for that same kind of collaborative disruption?